Yeah, markets are much more interesting at the moment. So the RBNZ had a meeting about 2 weeks ago, and we've also had some CPI data. The result of that is that the market's really aggressively forecasting rate cuts much sooner than had previously been thought. When we think about things like GDP growth, which at a headline level is flat, but on a per capita basis is negative. Things like business intentions and consumer confidence is well suppressed, down around GFC levels. Rates lower sooner make more sense to us, and the market likes that. So NZX 50 is up about 3.5% since the RBNZ meeting. Lower rates is good news for a lot of the companies that we own. So companies that hold debt will have a lower cost of debt, so that's good news. When we think about dividends as an alternative to bond payments or interest payments, so companies that pay good dividends should perform well in a lower rates environment, and also companies that get driven by sentiment. So thinking about the retirement sector in particular, the housing market should perform well in a lower rates environment. Positive housing market sentiment means that the retirement sector generally performs well, and that's what we've seen over the last couple of weeks. So our outlook, while we remain encouraged by recent share market performance, we still remain focused on quality earnings and quality growth. The market can get ahead of itself in situations like this, and we still think it's appropriate to remain defensive. So while we like what we've seen initially, and we do want a lower rates environment, we think our positions still perform better in that environment. We're still concerned about things like consumer spending, things like business intentions, and how that might flow through to company earnings, which we think might remain weak over the next period. So in terms of our portfolio positioning, while we're encouraged by recent movements lower in rates and recent share market performance, we think what we need to see is actually more than just forecasting of lower rates. What we need to see is embedded lower rates for that to flow through to the wider economy. So with that in mind, we remain cautious and we remain defensive. We're taking opportunities in things like retirement village stocks and real estate stocks, but for the most part, we're cautious around company earnings, and we think the next period will still be quite challenging for quite a few companies in New Zealand.